Well, guys, it's been a while since we've seen a moment quite like this. A calm before the storm in what's called Wall Street's fear gauge. Yes, the VIX has actually dropped down to levels in terms of ratio that we haven't seen in a while. And the last 4 times this has occurred, it's led to over a 10% decline. So could it be the same now into 2026? And more importantly, what does it mean for some of the biggest asset classes in the world? As Bitcoin breaks down and potentially hits the overall production cost, and of course metals start to go on a rampage. Join us in Pepperstone's Macro Edge as we break down everything that you need to know right now. Well, welcome back everybody to Pepperstone's Macro Edge. My name's Thomas Atkinson, and in today's video, we'll be breaking down everything from the macro to the data to, of course, Wall Street is doing right now. But we'll start off with this important chart here from Subutrade over on X, which basically shows that Wall Street's favorite fear gauge is starting to show calm in the current market and potential fear in the future. Yes, we've gone underneath that magical 0.8 ratio in terms of 1 month to 3 month structure. And if you're not familiar with this, it's something we do cover here on the Macro Edge, so make sure to subscribe to it. But it can both show times of potential uncertainty and buying potential, and of course, points of maybe too much calmness. And we are heading into what we call the Christmas period. So in previous times, while markets have rallied as much as 5%, at least in the last 4 times, all have actually dropped 10% plus in aftermarkets. So it could be a little bit of a problem moving forward. So let's break down what that could mean for all of us as traders and investors. First up, let's take a look at the flows. The overall flows so far this year have been pretty positive. In fact, in year 4 of this bull market, yes, it's been that long, we are averaging $5.5 billion per day, according to Strategas and Bloomberg on this chart. And that does point towards what we call window dressing into the end of the year. But not everything is so good. Some things are starting to show signs of liquidity and stress in the system. And one of those is, of course, the Federal Reserve and the repo market. The banking system seems to be needing money more and more over the last couple of months, and it's something we've been tracking. And it is starting to look like that 2018-19 market, where, of course, something did go wrong and there was a black swan event, but there were already structural issues. Is this a warning sign? I would say it's kind of like an amber event in markets, and it's something we need to continue to watch. Another one of the things that we need to continue to look at is cash burn. And cash burn has been accelerating recently from some of the biggest companies in the world. And in particular, all eyes have been on Oracle. You can see here also Meta is starting to run out of cash as more and more money is being spent in the data center world. And it's leading to some concerns here from Wall Street. You can see here Holger actually shows over on X that according to the CDs, that is the credit default swaps, bonds in Oracle are demanding, of course, more premium as people start to get more worried about whether there is a debt crisis about to occur. And this is something we saw back in 2008 as well. And of course, we saw the rise of it during the last bear market, which was 2022. Now, why is this all important? Well, it means we have to start looking at what Wall Street's doing and not, of course, what they're saying. And one of the big things that we've seen recently has been a movement into breadth. Wall Street's been basically buying up different stock market sectors as they've been chasing, trying to get back into the good graces of investors' minds. Why? Because they've been behind the S&P. In fact, last week, technology might have been down and communications were, but according to Duality Research, 336 of the S&P 500 stocks were actually beating the S&P themselves. And this is not a new phenomenon. It's something we've been talking about since the rate cut in September from the Fed. We've had small caps, we've had different sectors start to actually lead the market. And while that looks good on the surface, there could be some problems on the horizon for that one. So is it all bad just yet? Well, maybe not. In fact, according to the market stats and Subutrade, as you'll see here, call volume is through the roof in terms of options, and put volume is also through the roof, showing that people have very, polarized sides on these markets. But in general times, at least when the puts go this high, usually the next couple of days, and more importantly, next few weeks, tend to look pretty good. And I think that's an important factor as we go later on into this year. Another thing is this chart here from Grant Hawkridge, who's over on X, shows that current markets are still making a series of higher highs and higher lows throughout the world. In fact, most markets are still doing pretty nicely. And it really brings into question, when will everyone panic? Is it something in the bonds, or is it going to be the Fed that starts cutting aggressively, similar to previous cycles, and causing a real sense of decline? Remember, when the Fed pivots, not everything is fantastic. It usually means the market needs support, and it's the speed of which they pivot that's so important. And this is going to be very big storyline as we lead into a new Fed chair in 2026. For the now time being, though, Christmas rallies do tend to come. You can see here from the daily chart book and Isabella.com and Goldman Sachs that the second half of December and first half of Jan do tend to be some of the better returns in markets around the world. And really, most eyes right now are on precious metals, as that seems to be where the money flow is going. It was first gold, then silver, now platinum, as you'll see today, and even copper miners have joined in. But for now, it hasn't been oil. And remember, oil does tend to be a political trade, so there are some problems there. Another thing to keep in mind as well has been that it takes a while to build a mine. So if metals do start to find shortages in 2026, it takes 15.7 years from discovery to production when it comes to these mines. So it's not like they can snap their fingers and fix it tomorrow. One of the things we've mentioned here on the show many times has been the structure of markets. It's so important to look at those. Well, one of the things that we read back in October was that we dropped the 50-day moving average, but that generally speaking, according here to Blue Curtic Markets, we would see a rally followed by vol, which is exactly where we are right now, and then followed by a potential sell in markets or even just a stabilization. Now, this is where we're starting to find ourselves. We're kind of here right now. And if we do rally into the end of the year and maybe the start of 2026, remember those VIX stats start to point towards volatility sometime over the next coming months. Remember, it's 1 month versus 3 months, which kind of suggests that there could be something problematic on the horizon. So let's now take a look at some of the most important charts right now, and one of them is always going to be the S&P 500. And there are some important points to be made here as volatility starts to set in. Number one, it hasn't made an all-time high, but what we have seen is we've seen some consolidation near the highs that also comes with an advanced decline line going up. Basically, this means more stocks have been going up than down, and overall, this is very unlikely, at least statistically, to be the top for the S&P. So if we do start to get pullbacks, there's at least a decent chance that rallies could be coming through. Some levels to look at, 6,800 and of course 6,770 are both going to be key zones to see whether the real market supports it, and it's something we're watching very closely. On the flip of that, of course, in the macro side of things, we're always looking at the bonds. Now, both high yield junk bonds and spreads seem to not really be showing too many signs of concern just yet. And it is something that we are, of course, watching very, very closely and will continue to monitor. But maybe the most interesting chart of all, other than some of the metals right now, has been, of course, crypto and Bitcoin. With Bitcoin failing to break above the 90,800 after taking this liquidity low, and at the moment pressing down on the 84,000. Some important notes here is that the trend is, of course, still technically in the downward side, and that we've also getting closer now, which is about 74K, to the average basically production cost. So, of course, if we're mining Bitcoin, it's going to cost us on average around this much to break even. Now, it's a very interesting point because 75K, 74K was the previous low back over here earlier in the year. And it also lines up very well with what has been historically kind of like a bottoming process for Bitcoin, at least in the past. Will it be the same again? It is one of the major charts that people are watching. And if we lose 84,000, I think that a lot of bears are going to start to try to press further upon Bitcoin because, of course, the charts do look that way. It's one of those ones that's in consolidation. Is it accumulation? Is it distribution? I think we'll find out relatively soon. Now, on the other charts, we've seen gold break out, which has been a bullish move we've talked about for a while. Silver begin a squeeze up to 63, 64 an ounce. But over the last couple of sessions, it's been all about platinum and palladium as well, with platinum breaking out to a new high here and actually doing something that I think is always great to look at on your charts, which is that it is starting to build up momentum against gold. Now, you're not familiar with doing cross-pair analysis, but it's something that we always do here on the Macro Edge. And that is because we're starting to see platinum outperform gold. And this looks like a technical flag for a lot of people. and could mark an interesting point here for markets. Are we going to go back to a 0.4 or 0.5 or 0.55 ratio? These are some interesting levels, of course, we'll be watching over the next coming weeks. Some other things that are important in today's market has been the positive gamma flow in Tesla, with Tesla doing 3.5. It kind of shows here that it's not just price action and flow, it's also a mixture of options market gamma squeezing as well that's going through. And this could mark a beginning here of moving towards the 500. And we've long discussed the idea of this being a double bottom. And it's interesting how price, options, and everything else kind of all fit together. So a really, really cool chart here to see as well at the moment. With so much implied volatility potentially coming in the next couple of months, we'd love to see you come and subscribe to the Pepperstone channel if you're watching this live or in video recording. And of course, if you haven't already, make sure to do that because we've got plenty of massive content to bring you in 2026. Guys, I hope you have a very Merry Christmas. Thank you so much for watching. And these are just some of the charts that are making the rounds right now. But I think in general, the structure is still holding into a potential Christmas rally. Will we get it, or are we about to see extreme volatility? Of course, the charts will tell us. And as we often say, patience, react, don't predict. Have a very Merry Christmas if you celebrate it. And of course, have a Happy New Year. Bye for now.